And in a lot of ways, that low rate environment, quantitative easing, and this very powerful forward guidance policy, which really is about telling markets what's going to happen or not going to happen. In the case of the Fed saying we will not raise rates for an extensive period of time, that can actually be very, very powerful, because ultimately it just forces people to look at the lack of return from cash. We all know that we've experienced years and years of essentially 0% yield on a checking account. And at some point you grow frustrated. You see asset prices rising and you say, wow, the opportunity cost of being defensive is just too high. I've got to get back into the market. In some ways, we're actually seeing the exact opposite scenario unfold now. The yield on cash is much higher than it was. It's not incredibly high in the context of history, but 2-3% you can get for doing nothing. That's a lot more than you got even a year or 2 years ago. I'd say the second thing that's happening is because the economy is on better footing, because inflation is now at target, the Fed is, of course, removing not just its the guidance that it provided for markets with respect to keeping rates low. It's selling off a lot of the holdings in its balance sheet. And this is a big deal. For years, the Fed had essentially provided certainty to markets. Its mandate now is requiring it to remove that certainty, remove the guardrails, so to speak. And it's an open question as to how robust the U.S. economy actually is with a normalized rate of interest. It's something that exceeds the rate of inflation, which we're just about there. We might be slightly north of the rate of inflation, but remember, we've had an economy for 7-8 years where the Fed funds rate was deliberately held well below the rate of inflation. That's very highly stimulative. It's very good for asset prices. So it's really an open question as this policy gets normalized.